Good evening, and welcome to Macro Talk. Tonight, we'll be discussing the economy of South America. We'll be focusing on 5 countries that are the best indicators of the economy in South America: Argentina, Brazil, Colombia, Chile, and Peru. In each of these countries' economies, we'll focus on major investment indicators, such as nominal GDP, population, our real GDP growth rate, exports, imports, stock exchange, and debt.
Argentina is one of South America's largest economies. Argentina is known for the rich natural resources based off of the agricultural and meat industry. In the early 2000s, the economy of Argentina was a little shaky, but from early 2003, the economy began to recover, supported by a combination of political stability, prudent macroeconomic policies, and favorable external conditions. The smooth political transition following the May 2003 presidential elections and the firm implementation of fiscal and monetary policies were critical in rebuilding the consumer and business confidence. With the financial markets stabilized and interest rates steadily reduced, confidence increased gradually, and consumption of agricultural goods and other investments rebounded. As a result, real GDP expanded at an annual rate of about 8% from 2003 to 2008, underpinned by a strong domestic demand, favorable terms of trade, and a competitive currency. After slowing sharply in 2009, growth recovered nicely in 2010 and 2011 before slowing again in 2012. See here in the graph of the GDP in Argentina, the trend is rising, and in 2014 the rate was 540 billion, and now in 2015 it has jumped to 545 billion. The positive GDP trend also means that the annual growth rate will be positive. As of last year, the growth rate was 2.3%, and now in 2015 it has followed along the upward trend shown in the graph and is 2.8%. The unemployment rate is 6.6% and is on a downward trend, which is in direct correlation with the GDP graph, which is increasing. That is because the GDP's increase means more product is being output and more employees are needed to create the product. Exports in Argentina are currently at $62.017 billion, and imports are at a staggering $75.362 billion. The next country is Colombia. In Colombia, over the last 7 years, the GDP growth is very strong, averaging 6.7% annually from 2005 to 2007. The economy slowed sharply in 2008 and barely grew in 2009, reflecting the impact of the global economic crisis. By 2010 and 2011, though, the economic growth of GDP had recovered. Foreign investment in public services and communication sectors and in natural resource exploitation requires approval from the National Planning Department. This requirement applies as well to the investments in financial institutions of more than 10%. Once the GDP recovered, the nominal GDP continued the upward trend and is now at a staggering $2,517.58 billion. The GDP annual growth rate has grown from 3% to 4.207%, which is extremely promising. The outgoing exports in Colombia are slightly smaller than imports. The exports come in at $79.450 billion, and the imports are $85.246 billion in U.S. currency as well. Unlike the other countries, Colombia has three stock markets in which people mainly invest in, which is the Bogota Stock Exchange, the Medellin Stock Exchange, and the Occidente Stock Exchange. The inflation rate, which shows a positive trend in this graph, has shown 5.35% in 2014, but has decreased in 2015 to 4.9%. Brazil, the land of the brave and the home of the Brazil nut, became under considerable stress in 2002 and 2003. The volatile external environment and concerns about the continuity of macroeconomic policies following the exchange and government led to a sharp decline in the external capital flow and the depreciation of the real GDP. In 2013, real GDP declined sharply to a growth rate of 1.1%, and the inflation rate rose to about 14.8% as a result of the continued depreciation of the real GDP. In the context, the favorable external environment, macroeconomic stability was restored in 2004 through strong macroeconomic policies in the pursuit of ambitious structural reforms, including tax and pension reforms and bankruptcy legislation. Consumer confidence increased and business climate improved. As a consequence, real GDP increased an annual average rate of nearly 5% between 2004 and 2008, while cautious monetary policy kept inflation low in the single digits. Affected by the global economic crisis, decline in the commodity prices, and external demand, the real GDP growth fell sharply in the 2 quarters to March 2009, but has simply improved, supported by the government's counter-cyclical measures. As a result, GDP growth through declining remained positive in 2009 before recovering strongly in 2010. Growth then slowed a bit in 2011 and further slowed again in 2012. The graph of GDP shows a negative trend in the graph. The GDP in Brazil was 2,346 billion in 2014, but in 2015, the nominal GDP 2,517.48 billion in 2015, which shows a possible upward trend. In previous years, the real GDP annual growth rate showed a decrease of 2.6% each year, but over the last year, it reversed and is now at a positive 2.734%. Brazilian exports are a little bit smaller than that of the imports, which come in at 475.344 billion, and the exports come in at 333.633 billion. Along with that, the two main exchanges in which people invest within Brazil is in Rio, and the other one is in Sao Paulo. The one downfall of Brazil is a slight increase in unemployment rate, which puts the unemployment at 7.6%. Next, we're off to Chile, the home of the Chile. In Chile, following an annual average growth rate of 5.2% from 2004 to 2007, real GDP slowed in 2008 and turned negative in 2009, along with all the other countries, as the economy was hit with the global crisis. In 2010, though, the country rebounded and then continued to rebound until it reached the normal numbers again in 2011 and 2012. According to Country Watch, the following calculations were made in 2014. The nominal GDP was on a positive trend, coming in at 321.62 billion United States dollars. Chile's GDP growth rate has decreased slightly in the past years, but has shown a positive trend which grew over 3% to a percentage of 4.5. Chile has a much smaller population than that of other countries, which comes in at 17.905 million. This may mean that the entire country may not be used to its full potential, and exports come in at $118.382 billion, and the imports come in at $136.014 billion. The main stock exchange in which people invest within Chile is the Santiago Stock Exchange. 30% of foreign investment must be placed in a non-interest bearing reserve account, and 35% withholding tax on interest, dividends, and long-term capital gains on listed shares is used. Chile currently has the largest debt of all the countries, coming in at $8,321.84 million. Peru, the powerhouse of the Cell, the land of Lake Titicaca, and the home of the Peruvians, enjoyed a rapid economic expansion in recent years, and real GDP growth continued to accelerate after 2005. Once again, in 2009, the country showed a sharp decline with the global crisis. And in 2010 and 2011, it rebounded back to its normal rates. According to Country Watch, the nominal GDP rose to $726.36 billion in U.S. currency. And that grew along with its annual growth rate, which was initially decreasing and is now at a staggering 5.898%. And along with the positive GDP growth rate, there is a decrease in the unemployment rate, which is now at 6.4%. Inflation rate is on an upward rise, unfortunately, which it is in at 5.4%. That's okay, though, because the GDP and the unemployment rates are so good that you don't need inflation rates. The exports of Peru are $47.922 billion in U.S. currency, and the imports are $67.327 United States dollars. The stock exchange that most people invest in Peru is the Bolsa de Valores de Lima, which probably has something to do with Lake Titicaca, because Lake Titicaca is awesome.